Imagine you are selling a company. The final price is not just the number. The final price is the number and the adjustments. It is the complete contractual clause. In mergers and acquisitions, or M&A operations, there are many adjustments. But within those adjustments, there is one that affects the price and reflects the company's financial reality. Today, in under 4 minutes, we will explain net financial debt clearly and simply, ideal for those who are not financial experts. Understanding this will help you see why it is essential in any company sale or purchase. Net financial debt is calculated with a basic formula. It's like subtracting your cash from what you owe and adjusting for changes in daily operating flow. Net financial debt equals financial debt minus cash, plus or minus the working capital adjustment. First, let's look at financial debt. Accrued interest for any debt. Short-term and long-term leasing. Confirming. This includes all of the company's financial obligations, such as creditor balances for corporate tax, creditors for short-term and long-term fixed assets, debts with banks or financial institutions, short-term or long-term, provisions for risks, expenses, and deferred taxes, creditor balances with partners, directors, or related parties, issuance of bonds, debentures, or promissory notes, liabilities for administrator remuneration, discounting of bills with or without recourse, incentives for managers related to a sale, factoring with or without recourse, direct expenses for the sale, any other exigible liability not reflected in the balance sheet, and dividends, distribution of reserves, capital increases or reductions. Important. For this calculation, we exclude debts between companies of the same group as they do not affect the external net value. Second, cash. This is simply the available cash and temporary financial investments of the group, such as money in bank accounts or short-term funds that can be quickly converted into cash. Third, the working capital adjustment. This corrects working capital to be representative. Working capital is the difference between current assets, such as inventory and accounts receivable, and current liabilities, such as accounts payable. The adjustment eliminates seasonal or specific effects, such as Christmas sales peaks, to use a normalized figure instead of the one at the exact moment of the transaction. In summary, net financial debt adjusts the purchase price in mergers and acquisitions by subtracting available cash from actual debts and normalizing operating flow. This ensures the buyer pays a fair value, reflecting the company's true financial health. Now you know why it is a cornerstone in these operations. Focus your queries and challenge our AI Atenea. Complex questions, expert answers. More information at ilpabogados.com.